It's no secret that condo markets across Canada's biggest cities are going through an existential crisis. Prices are crashing, and many buyers have loans on their units that are larger than the actual value of the property. In other words, they're underwater. And matters would be worse if it weren't for a sneaky bailout that the banks are giving to themselves and to developers. A bailout that average people like you and I can't get. But more and more people are saying that the real killer is something else entirely, and it has to do with what Canada does differently from everywhere else in the world. So let's talk about the silent killer of the Canadian condo market, the hidden crisis of underwater condo buyers, and what the big banks are doing to cover it all up. To understand what's happening today, we first need to understand what got us here. All throughout the 2010s and into the early 2020s, condo markets across the country were booming, with consistent growth year over year over year. This was largely as a result of the low interest rates in Canada following the financial crisis. Now, all during this period, rates remained lower than normal for a lot longer than normal. This led to a consistently rising market that made a lot of people happy because they made a lot of money. Condo developers could pre-sell all the units before they even started building because investors would gladly buy them. Many mom and pop investors thought that they could sell the units later for a profit, or at the very least rent them out and borrow against their rising value to keep on buying more and more condo units, repeating the cycle and making a boatload of money. And for a long time, they were right. As long as prices kept going up, the plan worked perfectly, and it led to a huge surge in the number of buildings being built, something that a lot of people were quite proud of at the time because we were increasing Canada's housing stock and growing the economy. But more recently, after a surge in interest rates and government supports to increase the amount of new apartment buildings, paired with a decline in Canadian population growth, well, demand for these condos has fallen off a cliff. As a result, all of a sudden, the model that made banks, developers, and investors boatloads of cash, well, that model no longer works when prices aren't perpetually rising. This cratering of demand has led to some of the lowest condo start numbers in decades. Urban Nation is reporting that in the Greater Toronto Hamilton area, in the first 3 months of the year, only 497 condo units started construction. That figure is not just the lowest in 29 years, but down 79% from the same period just a year ago. In short, because the model we talked about no longer works, well, new condos aren't being built. But this is where things get interesting, because there are thousands of condo buyers, largely individual investors, who bought back in early 2022 when the model was still working, and prices looked like they just keep on going up and up and up. But today, they're in an impossible situation that has magically been made possible again by some less than above board decisions made by Canada's big banks. Decisions that act as a silent bailout for these banks themselves, for the condo developers, and to a lesser extent, the investors. Here's an example of the problem, a hypothetical situation. Let's say a person wanted to buy a condo back in 2021 and it was worth $500,000 at the time. Other similar units were selling for that, so they thought, okay, well, this is reasonable to cost $500,000. I've got my $100,000 deposit or this down payment. I'll buy it pre-construction and I should be good. I know that there are mortgage rules that mean I can only get a mortgage the size of 80% of the value of the property, but since I'm bringing this $100,000 down payment, I should be able to get a $400,000 mortgage from a big bank like RBC. They'll provide me that 80% as long as I've brought this 20%. So back in 2021, I paid this $100,000 deposit on a $500,000 condo. Skip forward 4 years, 2025, the prices of those condos have gone down. Now it's only worth $400,000, and despite me bringing this $100,000 to pay for this initially, well, that has gone up in smoke because I'm still obligated to pay this $500,000, even though the condo is only worth $400,000. Now, all of a sudden, because the condo is only worth $400,000 and I need $400,000 to buy it because this $100,000 went towards this $500,000 purchase price, well, now RBC is saying, well, actually, that's not 80% anymore. We'd be financing 100% of your property's value. That's too big of a mortgage for us. So this is a big problem. Most of the buyers in a building can no longer qualify for a mortgage to purchase their units now that the building's done. They either need to come up with a huge chunk of money that would then allow them to qualify, bringing them to that 80% point, or they may just choose to walk away from their deposit, losing tens of thousands of dollars, while at the same time risking having the developer sue them for damages, because they're not in the clear either. The developer owes money to a big bank that lent them hundreds of millions of dollars to build the building in the first place. And the big bank lent them this money because they knew that most of the units were already pre-sold. With buyers walking away, you can start to see how this house of cards could crumble. The buyer walks away, the developer can no longer sell the unit for the amount that would allow them to pay back their big bank lender, meaning the developer could go under, while at the same time, the big bank itself could end up being in a significant, stressful situation, losing those hundreds of millions of dollars that it lent to the developer. That's where the hidden bailout comes in, because to stop all of this from happening, the banks are bailing out the developers by playing fast and loose with mortgage rules, giving these condos a break while average people like you and I have to continue playing by the rules. We'll get into exactly how all of this is happening, but first, I want to thank the sponsor of today's video, and that's Lion Rock Resources. Now, to be clear, this is a paid promotion on behalf of Lion Rock Resources, and it's not financial advice or any type of investment advice. You can see the full disclaimer in the description. Now, Lion Rock is a Canadian-listed and publicly traded minerals exploration company, and they wanted to share news about their project in South Dakota that could have a mix of both gold and lithium. Now, admittedly, they're still in the early stages, but a drill program is coming up soon for their project called Volney, and that'll give them a better idea of what's underground and what the potential for this project really is. But they do have some reasons to be optimistic. First of all, it's in a really interesting location right near some historically successful gold mines, one of which produced over 40 million ounces. Now, on top of that, Lion Rock is seeing signs that there might be high-grade lithium in the same area. So on top of the gold potential, it seems that they could also have access to lithium, the highly sought-after mineral, which is used dominantly for rechargeable batteries. Now, with gold trading near all-time highs and with many projecting that lithium could become more valuable over time, well, Lion Rock sees some potential with this project. The team behind Lion Rock has experience finding and developing resource projects, and the project they're currently working on is accessible year-round and is in a jurisdiction that is friendly to mining, so they project to not have too many issues with permitting. Now again, this is a paid advertisement and is not financial advice, but if the gold and lithium potential plays out, well, there's a chance that this could be reflected in the value of the company in the future. And as with any company, there are some potential risks in the future as well. We'll get a better idea of all of that in the coming months as they expand their drilling program. But at the very least, with a market cap of around $20 million in Canadian dollars, well, some investors might be interested in keeping an eye on the company. If that sounds like you and you're curious, well, you can check them out at lionrockresources.com or look up the ticker symbol ROAR on the TSX Venture Exchange. Now, thanks again to Lion Rock for their support of this channel. And once again, this has been a paid advertisement and has not been a stock recommendation or any type of financial advice. So everybody in the food chain is facing a bad situation now. Condo buyers can't complete their purchase because they can't get mortgages, and developers can't pay back their massive construction loans. This is where the banks come in to save the day, changing their rules on a dime with a practice called blanket appraisals. Listen to this. In this article, they describe this less than normal practice. They say real estate developers and one major bank offering blanket appraisals in a scramble to save pre-construction deals. They explain that a blanket appraisal is when a lender uses the value of a pre-construction property at the time a buyer entered the purchase agreement rather than the updated value at the time the property closes. So today, the condo that I agreed to pay $500,000 for, when compared to other condos that are selling in the resale market, would only be worth $400,000. When you look at the other one-bedroom condos that have sold recently, that's all they're going for, even though I agreed to pay $500,000. That's a tough situation. Usually, I would no longer be able to get a mortgage unless I brought significant extra cash to the deal, but that's where blanket mortgages come in. Banks like RBC come in and say, you know what, even though technically when we look at other properties, your property is only worth $400,000, just between us, we'll just say in this appraisal it's actually still worth $500,000, and we can just keep on going forward as usual. Don't look at the man behind the curtain. So the buyer can get a mortgage as if their property was worth $500,000 when it's only worth $400,000. This leaves them with a giant mortgage, but it could be better in their situation as well because it means they don't have to walk away from their $100,000 deposit entirely and risk the condo or the developer suing them for damages. So is this blanket mortgage appraisal against the rules? It seems kind of fishy. It's not the true value of the property. It's this sort of arbitrary, based on the time that you purchased it, valuation model. Is it against the rules? Well, yes and no. Let me explain. These are the guidelines as published by OSFI, or the Office of the Superintendent of Financial Institutions Canada. This is the regulatory body that handles the big banks. They regulate these big banks. And they talk about property appraisals. They say that in assessing the value of a property, FRFIs, which is federally regulated financial institutions, i.e. the big banks, well, they should take a risk-based approach and consider a combination of valuation tools and appraisal processes appropriate to the risk being undertaken. They continue to say where FRFIs use automated valuation tools, processes should be established to monitor their ongoing effectiveness in representing the market value of a property. They're supposed to effectively represent the market value of a property. So despite these rather softly worded guidelines, instead of doing real appraisals where the unit is compared to recent sales of other similar units, which would accurately reflect the true value of the unit as it would sell on the resale market, well, now the bank is offering blanket, or in other words, catch-all appraisals, where every single unit in a building will appraise for a set amount, and that amount is the amount that it initially sold for, even if that was 4 or 5 years ago. It's regardless of what other similar condos are selling for. And this allows the condo buyer to get their mortgage, even if it means their deposit down payment equity has gone up in smoke. But you might be saying, well, Russ, the mortgage rules are there for a reason. Why would the bank take on the risk of giving mortgages to buyers that are underwater from the get-go, from the very beginning? Doesn't that increase the risk that they could stop making their mortgage payments and default on their mortgage? And well, yeah, you'd be right. But it's a calculated decision that becomes obvious when you take another look at our drawing. Why would banks like RBC give mortgage buyers mortgages that are worth the entire true value of a condo? Well, it makes a lot more sense when you realize that these same banks that are giving out the end buyers mortgages, well, they also finance the initial construction for the condo developer. If these buyers can't close and this developer doesn't have enough money as a result of that lack of closing, well, this developer can't pay RBC back the money that they initially loaned them as a construction loan to build the building. So it seems that ultimately the bank has decided that the risk of giving all these mortgages to overextended buyers is a better outcome than risking that the developer they lent hundreds of millions of dollars to may not be able to pay them back. Do you get where I'm going here? The banks are bailing themselves and the developers out of a crummy situation. Now, in response to questions about this, the RBC says that our property valuation methods, including appraisals on pre-construction properties, are based on a number of market conditions, including those at a time a financing decision on a mortgage application is made, i.e., will lend to you based on the value previously, 4 years ago. Now, this happens for these condos, but not for average people who may be underwater on their mortgages and trying to get a mortgage renewal on a single family home. That doesn't happen. And even though this big bank is really stretching what is a reasonable appraisal when it comes to the rules they need to follow, well, at the same time, their regulator, OSFI, the Office for the Superintendent of Financial Institutions, it's a mouthful, well, they don't seem to have a problem with it either. They may also be making the calculation that this mini bailout for the developers and for the bank in the long run might be more important than enforcing equal rules for all market participants. And all things considered, well, that might be reasonable. They might be right. It might be a worse situation if all of a sudden one of Canada's biggest banks is short hundreds of millions of dollars while major condo developers go bust and buyers walk away from their purchases. Even though it may not be entirely fair, they might be making the right decision here. I don't know. But here's another interesting angle. If it weren't for the regulator turning a blind eye and the banks making use of these near fantasy blanket appraisal practices, well, the already struggling condo market could be cratering even more than it is today. Now, obviously, there are big problems in the condo market, but not just when it comes to these wonky financing methods. There's another elephant in the room, and that elephant is that most condos in Canada aren't being built for families or for the people who will actually live in the condos. Instead, developers tend to build for the people who usually are the ones buying the condo units, not families, but investors most of the time. And these investors are rationally looking for the lowest cost, highest return on investment option. Wouldn't you be if you were investing in a condo? And as it turns out, that's not a 3-bedroom, 2-bathroom that would be suitable for a family. Usually it ends up being an incredibly small 1-bedroom or studio condo, more often crudely known as a dog crate condo. Now, with investor demand drying up, the true killer of the condo market could be that people simply don't want to buy the kind of units that are available. In a recent interview on the Move Smartly podcast, you should check it out, the hosts John Pasalis and Urmi Desai interview Puyan Safapur, a developer who says that this investor-led system that incentivizes these micro-condos, well, that could be the true culprit here, alongside the way these construction projects are financed, which, as it turns out, is entirely different in Canada versus most of the rest of the world.
The reason why we have this structure is financing. So that's how financing comes into play. It's because we need to sell, the developer needs to sell approximately 70% of the revenue in a project before they can get financing to build, as opposed to everywhere else in the world. I do feel like until we in some way address this fundamental issue, we're going to keep tripping up. And even if the market, because of external factors, picks up, or there's tax relief or whatever it is, like if we don't face this issue, we're just going to keep coming back to it.
So in Canada, in order for a developer to finance the construction of a major project, in order to get a loan from a bank, they need to first sell approximately 70% of the units before they even break ground, before they start building. Whereas in other major markets, the banks would take on the risk of financing the developer during construction before units are sold to the end users. Then the developer would sell the units once they're already complete. In Canada, in practical terms, most buyers who can pay a massive deposit in this pre-sale model and wait 5 years for the building to complete, well, these are people who often aren't buying for themselves. They're investors. Families usually can't look 5 years ahead and predict their housing needs, so the developer is incentivized to build the type of unit that their buyers want. The buyers aren't the people who will rent and live there, but instead the investor who's looking for the low price, high return micro condo option. Additionally, when the condo builder has sold most of their units before construction begins, they also lose all incentive to actually care about the product they're building. It makes sense. Like, why worry about the desirability of the build location or the quality of the finishes when it's already all been sold? If they had to sell after the product was built, like every other type of company does, well, then they'd have to care about these types of things because they would need to in order to actually make the sale. Safapur adds that this model isn't here for no reason. It's a product of our quite conservative banking system.
We're known to have a conservative banking system, which I think is really good, actually. I mean, so much of the reason why we've weathered, whether it's the 2008 crises, in times after that, we have less kind of swings of ups and less swings of down because we have a more steady and conservative and more centralized banking regulations. So they said, sell enough so that at least, we know that when it comes to closing, assuming everyone closes, we get our, we can at least the bank can get their money back. The people who are currently, running things, they're not aware, they don't realize that this structure is causing so much fundamental damage. They just feel like that was a good conservative structure, and it's been around for decades, and it's just really hard to change anything at banks.
So while Canada's conservative banking sector uses this pre-construction sale model to reduce the risk of lending to developers, at the same time they don't realize that this model could be resulting in buyers who overwhelmingly aren't going to live in the condos, having the trickle-down effect of the developer not building based on the needs of actual residents, but building based on the needs of the investor that they're selling to in this model. But as we can see, when that investor demand dries up like it is today, and we no longer have up-only prices where speculators can bank on guaranteed returns, well, it's families who could potentially fill this demand gap. They could potentially buy the units, but they often won't because the units simply don't meet their needs for growing a family. It's true, the added safety for the banks from this pre-construction model gives them more stability in certain situations, but it has also led to the situation that we're in today, where they need to give out less than prudent mortgages to ensure that pre-sold units can close, even when the market's dropping. So they trade out one risk for another risk while creating housing that doesn't fit the needs of most people, apart from rentals for young professionals and students in unique situations. While interest rates and low demand might have brought about this condo market slowdown, it may be the financing model and the resulting poor product that ultimately spells the end of the condo market, at least as we know it. Here's hoping that there can be some kind of reform that results in a less speculative market where developers sell to the people who will actually live there, and where there's not this need for an investor class middleman in every single condo building in the financing of the construction. Well, at the very least now, the conversation has started about all of this. And who knows where it's going to go? I know that I'm going to be keeping my eye on it and making videos about it as things develop, so subscribe to the channel if you haven't already done so. And let me know what you think about all of this. What do you think of the idea that the financing model is actually creating poor products that people don't want? What do you think of these bank quasi-bailouts of both the developers and the people who are underwater on their mortgages? To me, it doesn't seem entirely fair that this would be used in certain situations, but not in others, but I can understand the logic of, well, maybe this was producing the far greater economic, or reducing the chance of far greater economic turmoil. I'm not entirely sure though. Let me know what I've gotten right here, what I've gotten wrong, and what I've missed entirely. I read every single comment, but with all of that said, thanks so much for watching the video, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.